Okay, welcome back everybody. So again, we're going to be going over, first off, when we talk about inventory, we're talking about merchandising inventory. So as I mentioned before, our main core of our business is going to be merchandising or retail type of business activity. So that means that's going to involve us actually purchasing inventory and then taking it, whatever, packaging it, making it somehow available, and then we sell it out to the public. Okay. Now, first off, what is inventory? Again, it's anything that you plan to purchase and you want to convert the cash into a good, and you want to convert the good into a sale and convert the sales into cash. So, since we're only mainly focusing on merchandising activity, our main goal is we're not going to produce these items. We're not going to sell a service. This is actually a solid product that we actually have to purchase it and then mark up with some kind of sales price that we want to be able to make a profit off of. So that's pretty much what inventory is. Now, there are typical business that typically do have or sell type of inventories. It's obviously going to be retail stores and as well as wholesalers. Okay. Wholesalers, they sell in bulk for a cheaper value. But then again, sometimes at a grander scale, you may not need all of those items. So typically wholesalers would actually be, if we are the small retail store, wholesalers would be something that we typically purchase the items from, or possibly directly from the manufacturer itself. So yes, so we buy things at cheap, and then we either market it, package it in our own type of material, and then we turn around and we sell that item. Okay, so that's inventory for you. Now, let's go ahead and talk about merchandising inventory. So, what does a cost of goods sold include? Well, it's pretty straightforward, right? It's going to include every single cost it gets, so then it becomes ready to sell. Okay? Now, when it is going to be anything that is ready to sell, it's going to include every single cost it takes to get the asset to the store. So, for example, we have the original purchase price of the item. We have sales tax if there is sales tax, okay? We have freight expense, we have shipping and handling, and we also have storage fees. So there's a lot of things that can go into inventory, and that's going to be considered part of the cost of goods sold. So every single item here is going to be what it costs you to purchase the item. Okay, now oftentimes this is what you will see is that typically when it becomes from a vendor to a customer relationship, if we typically can prove that we are a legitimate business, what happens is the manufacturer or the wholesaler can tax exempt us. Okay, now that does not apply every single time. Okay, oftentimes, even if you are tax exempt, sometimes if you have to, if it's like an emergency, you have to go run out to the physical store, you're still gonna have to be paying sales tax. So sales tax is going to be one of those things that you want to be careful, because again, Costco used to tax exempt all businesses. Now that it's open to every single person, people can apply for an executive membership to Costco. They decided to treat everybody as equal, so that now for businesses who own a Costco card, you actually are subject to sales tax. I believe this actually was pretty fairly recent, because I know back then, when we used to own a business, we actually were tax exempt. Now, of course, other things like if you're selling groceries and things like that, of course, you're going to be tax exempt. Okay. So inventory And cost of goods sold, it's going to include every single cost it takes to get your asset to the store or your inventory to the store. Okay? Any questions in regards to this? Okay. Now I'm going to talk to you about how shipping or freight on board actually works. This is kind of important in respect to who has ownership of the asset and how the ownership gets transferred to from one owner to another. Okay. So two things that you need to know is, what does FOB mean? FOB means freight on board. Typically, freight on boards are usually things that you pay separate shipping and handling for. Okay, and you have a few options here. You have it that where you can it could be a separate shipping company that charges you, or it could also be something that you could be billed for. Okay. Whereas COD is actually cash on delivery. Now, oftentimes, this was not widely as used, but for example, like if they have a third-party vendor who ships things to you, you may have to pay a fee in order to obtain all the items. So usually, if it's a separate shipping company and they don't charge you freight charges, they'll have a third-party vendor that will send you stuff, but they want to be paid at the time of transferring the items. So that's cash on delivery. Okay. Now, so here's a couple concepts here. Now, this is first, the one that we're going to be looking at is going to be freight on board, or FOB for short, shipping point. This is where the items that you purchase, so from the seller's store to a midpoint, that's going to be FOB shipping point. So that right now, who owns or who has to pay for the shipping is going to be the buyer. Okay? The buyer has full responsibility when it becomes FOB shipping point. Okay? Now once it reaches the middle point and then it makes it to the buyer's store, okay, now the seller is responsible for that item, okay? The ownership has been transferred over, but however, the seller is responsible to pay for the shipping cost that way. So if we actually break it down, right, there are two people that actually have to pay into shipping and handling. Usually they charge you like maybe $16, depending on what the item is. They charge you $16 shipping and handling. That's to get the item from the seller's store to the midpoint. Then, of course, the seller has to also pay an additional $16 to go ahead and get the items from the middle point all the way up to the buyer's store. So shipping and handling is very, very expensive. Especially when you're shipping items, and depending on how you have them, is it first priority? Is it expedited shipping? Is it fragile shipping? You know, there's a lot of things that come into factors, especially when you're shipping out items, and especially when you're shipping out merchandise. So with that concept being said, we have to also figure out the idea. So the second part is called shipping destination, or it's also, shipping destination. Okay, so once the asset comes from the middle point to the actual buyer's store, the seller is responsible to pay for the shipping for that. Now, I'm going to give you a clear example what happens here. Now, the ownership is being it's in the process of being transferred. Now, since the midpoint to the buyer's store, if the seller is responsible, think of it this way. Amazon. You buy something from them and that item never reaches your location. who is responsible? The seller is responsible. So that means the seller is responsible to pay for either shipping for another item to be shipped out, or it could be, you can refund the buyer. So think of it that way. Now, if for any reason the buyer, buys the item and it never ships, then the only person that's responsible is, obviously, they're not going to charge you. Okay, so that's oftentimes too with Amazon too. If something's not ready to be shipped out, or if there's an item that's not available, they don't charge you until they ship it out. So that's the same exact concept there. So think of it that way. Apply Amazon to this scenario and it makes sense. Okay. Now, any questions in regards to FOB, shipping point, and destination? Now, another word too for shipping point is also origination, where it originally came from, okay, for shipping point. But for destination, there's only one destination, okay? Any questions? Okay. So now I'm going to actually talk about how inventory is actually tracked. Now there are two tracking methods when it comes to tracking inventory. We have periodic inventory and we have perpetual inventory, okay? Now I'm going to explain pretty briefly about each one, but for the remainder of the rest of this chapter, we're only going to primarily focus on periodic. Once the first exam is out of the way, then I'm going to teach in chapter 7 and chapter 8 is actually going to be the second type of tracking method, okay? Because both methods are actually widely used. One may benefit you depending on what kind of business you are, but I'm going to teach you both concepts, and I'm going to teach them separately so then you guys don't get confused. So periodic inventory, okay, is typically going to be inventory that you purchase, and it's also defined as, periodically, like every once in a while, okay? Whereas perpetual inventory, right, perpetual actually means constantly. So when we're focusing on periodic inventory, if you're only going to be looking at it every once in a while, periodically, right, once in a while, that's exactly how you're actually going to be tracking your items. You only check at them every once in a while. So if you've ever talked to someone who's actually been in the sales department, oftentimes when their shop is closed, someone's going to be taking a physical count of all the items that they have in the store. That is exactly what periodic inventory is. Sometimes they don't count at the end of the day, they count at the end of the week or even at the end of the month. So how we interpret periodic inventory is we actually choose when whatever the item is, it doesn't give us important reasons to constantly be checking it up or even updating our inventory. All we care about is did we purchase it? If we did, okay, then we should roughly have this much. But we won't know until someone physically goes down into the basement or the warehouse and actually takes a physical count. So when you take the physical count, you guys, it's depending on your company, right? If you have too many items, it's definitely, obviously, if you have someone to have to go on the floor every night to count every single item, then you can already make the assumption that maybe this is a weekend kind of thing. So, but if you only have like minor items that's you're able to count physically, then there you go. Okay. Then do it every day or at the end of the day, at the end of a week, end of the month, whatever it is that makes sense to you for your business. So that is what we're going to be doing. Now, another thing that I want to also talk about, so that's just understanding how it's being tracked. It's tracked every once in a while. And what's actually necessary is that you do need to take a physical count. Whereas perpetual inventory, since the definition of perpetual inventory is constantly, what that means is we're constantly updating our inventory. So when we track everything that we are tracking each item, not only are we keeping track of how many items we purchase, we're also keeping track of how many items we sell. Okay, so this one is more for typical items that you want to make sure that you want to keep a good track for. If you purchase something and the minute you sell it, you're going to update your inventory so you always know how much inventory you have at all times, whether you take a physical count or not. Okay? Excuse me. So again, it could be daily, weekly, or every monthly, right? It doesn't matter what given time you are in, you always know a rough estimate, or you always know how much inventory you actually have, because you're always updating how many items you purchase, and you're also getting rid of them every time you make a sale. Okay, so that's the difference between the two in terms of tracking. Now, in terms of journalizing or recording this transaction, there are two key differences. When you are using periodic inventory, you are assuming that that when you make a purchase, it's going to be considered as an expense. So what you're going to be looking at is you're going to have a purchase expense. Okay. Whereas when you're dealing with perpetual inventory, you're actually dealing it as when you make the purchase of it, it goes straight and directly into inventory. Okay? So again, periodic is a purchase expense. It's an expense to the company. Whereas perpetual is a straight inventory item. It's an asset. Okay? So that's the real difference, is one is an expense and the other is an actual asset. Okay? So again, we are not going to be learning about perpetual until after the first exam. Okay? Any questions in regards to any the tracking methods for inventory? Okay? Now, again, another question that some people have asked me before is, which one is commonly used? They both are commonly used. And it also depends on what kind of company or what kind of business or what kind of items you sell. Okay? For example, perpetual inventory. If you sell grocery items, or you sell something like that, perishable goods, typically, of course, you want to count how many items you have, because at the end of the day, you're going to have to get rid of them as soon as they go bad. Where periodic, I guess you could think about this as if it's like a shelf life that has a long shelf life. But another thing too is it's also for items that typically, like, if it's not your main core of your business, such as, for example, we'll dive into coffee cafe. We sell coffee. Our main core business is to sell coffee, not to sell our merch, which is like t-shirts or coffee mugs. That's not something that we keep true track of. Our main goal is to keep track of our coffee that we actually produce and we actually sell. Okay? So any questions in regards to that? Okay, then let's go ahead and move on. So now we're going to be talking about periodic inventory and how it is when we actually make our purchases. So here's a good example right here. Example number 1. On July 1st, XYZ company purchases 100 units of toys, okay, from Toys U, okay? And each one cost you $5.65 each, and freight cost you a total of $100. purchased, oh, sorry. Purchase was made on account. Okay, so that means you had an account with this person. So how do you record this transaction? All right. So again, we talked about how periodic inventory. The one thing that you need to understand that when you make your purchases of inventory, you're purchasing it as an expense. So if you guys remember the few items that are considered cost of goods sold, is going to be the original purchase price, which is your purchase expense. Any freight expense is considered one of them. Sales tax expense, right? In case you do have to pay tax on it. Even expedited expenses could be there as well. All of those are going to be considered as expenses, okay? Because they're all contributing to the one key factor, which is purchasing periodic inventory. Now, however, for this course, for those who are newer to this kind of idea, we are not going to be testing you on anything other than freight expense and purchase expense, okay? Just because those kind of things, again, if you are the inventory manager, then yes, you will deal with all of these things. But right now, I'm not teaching you to be an inventory manager. I'm teaching you how to be an accountant / bookkeeper. So understanding that these notions or these key factors is what affects a transaction, and you're going to be the one that's recording it. So in this kind of aspect, I only want you to only know freight expense and purchase expense. Okay? So here you go. My purchase expense. Okay? So here's my journal here. Now I need to recognize what account I'm going to have. Okay? So if we know that we have a purchase expense, okay, if I bought 100 toys costing me at $5.65, how much is my total purchase expense going to be? $565. Good. And we also have a little notion here that our freight cost, it costs us $100 to ship. Okay? So because we recognize two key factors, right? We're looking at purchases of inventory, and they're going to be categorized as expenses. So what do we know about expenses? How are they usually recorded as? What's their normal balance when it comes to expenses? They're increased by debits, correct. And then here's a little notion that, or a little terminology that we need to understand because this is common. When anything is placed on an account, the assumption is, did we pay for this item right now? No. We didn't pay them right then and there. We placed it on an account, meaning we have an account balance with this company. So that means they're going to bill us a statement that tells us that because you place it on an account, you don't need to pay it now. You're going to have to pay it later. All right? So the assumption is if we owe the money, what is our first thing that what is the first thing that comes to our mind? It's a payable, or in other sense, it's a liability, meaning what kind of normal balance does a liability have? Good. So in this case, we recognize we have a purchase expense for the $565, okay? And it's on the debit side because we know that we're increasing our expenses, so therefore we need to debit our account, okay? Another key factor that we need to also look at is freight expense is going to be a separate cost. But in the overall purchase itself, it's all tied into shipping the toys that we bought. So all of this is going to be considered one, but we need to separate the cost because it's a separate expense to the company. So therefore, we need to recognize the freight expense for $100. Okay? Now, how much in grand total do we need to have that we actually owe?
60.
Correct. And then what always has to be true when we complete our journal? Debits have to equal credits. So here you go. My debits match my credits. And that's exactly how you're going to journalize a purchase of inventory under a periodic, under the periodic tracking method. Any questions in regards to this? Okay. Pretty easy, pretty straightforward. All you need to know is the purchase price, how much did shipping cost you, and overall, what was the total amount that we owe. Or in this case, because we didn't pay with cash. Okay, so there you go. We hit every single thing here. We understood how transaction analysis works, and there you go. That's a perfect example of how a journal is done. Okay, any questions? Okay, no? All right, so let's go ahead and move on to the next section here. Now, of course, when we make purchases of inventory, there's always going to be some kind of incentive that the vendor is going to be having with you, especially if you're a loyal customer of theirs. They want to be able to, be able to give you these discounts, especially if you're buying in bulk. You're buying thousands of items from this particular vendor. So what we're gonna do is we're gonna look at if we do make purchases, what happens when there's a purchase discount involved. Okay. So let's go ahead and look at this. So this is what terms are. So terms are basically an incentive for either a customer to vendor relationship that allows the person to take advantage of a discount if they pay within a criteria. So for example, when you see 2%, 15, net 30, what this actually means is I will give you 2% discount if you can pay me back within the first 15 days of your transaction. If not, the whole entire bill is due within 30 days. Okay? So how we understand that is especially when we owe a particular client, they're not going to allow you to owe them beyond a given time period. Especially like if you're making purchases with this particular vendor, oftentimes you'll see 30 or 60 or even 90 days, depending what you're purchasing from them. But most oftentimes is they try to give you an incentive by trying to pay them back or try to pay them for what you owe in a timely manner. Of course, for all good business practices, if you're trying to sell something to somebody, you want your money back. You never want to wait till last minute because and we'll talk about this in chapter 10 is, well, what are the possibilities? What if it's already 15 days and 30 days are coming up and I say I'm not going to pay you? Then what happens there? Then we'll talk about this. We'll understand what bad debt is. So that's the risk when it comes to having terms or even selling an item to a person on a payable account, right? Letting them owe you money. Because in this case, yes, you made your sale, but the bad thing is you actually didn't get the money that you were actually, you're supposed to actually earn. So in this case, that's why they give you an incentive. If you can pay within the first 15 days, then you know what? I'll give you a discount because you paid me back in time. Okay? But if not, then you pay me the whole thing in 30 days. Okay? So that's what this little concept here is for. All right? Now, we're going to go ahead and apply it to how we actually understand it. Now, there are two methods under the purchase discount. There's the net method, and then there is the gross method. Net method pretty much straightforward, means that you're going to take the discount now, immediately, okay? And we'll understand this in a second. Now, whereas gross method, right? You don't take the discount right away. You just kind of wait till when you actually have enough money to pay for it. Then if you make the discount, then great. If you didn't make the discount, then no problem, okay? So you don't take the discount until later on. Now, the reason why a lot of people use either or methods is because, for example, net method is usually typical for people that like to pay like immediately, okay? Or they just have enough money to go ahead and just pay for it so they could take the discount, okay? But oftentimes what happens is that in case you do forget, there are some, precautions of what happens if you do miss the discount period or the discount window. However, net method is only primarily used for those companies who are very good at paying their bills on time, or usually if they make a purchase of inventory, they usually pay within the first 5 days of actually purchasing it, or they pay it the next day. So someone who's actually really good at paying their bills is going to want it, would just use the net method the way it is, okay? Now, oftentimes, if you are that kind of company who's starting out slow, or you are a small business, you can't actually make those, payments right away. Maybe you have other priorities that you may have to pay for first, and then all this extra stuff is going to be secondary, or not too much of a priority. So that's why you're given that window where you're given 15 days or you're given 30. Now, in this case, when a gross method happens is, when you record it at what you originally purchased it from. And if you happen to pay for it and you made the discount period, then great, you can go ahead and calculate it and place the discount in there. But if not, then that's fine. You don't have to worry too much about it. So this one's more for lenient for people who are not really good at paying their bills, or they just don't have enough money for it, or they just have other priorities that need to be paid off first. So gross method is actually one of the more common ones to use, and is actually one of the best methods to use, just because, again, for smaller companies, you never want to be too sure, or you might not have enough money to just go ahead and just pay for something amount, especially if you're buying thousands of inventory items at one time. Okay, so let's go ahead and look at an example. So we're going to start with the gross method. So then this one's a little more easier, as well as easier to understand. So the first one here on example here, first example is going to be on February 1st. You purchase 100 coffee mugs on account from Cuppy's Co. Okay? And it costs you $1.25 each. Okay? Another thing too is that the freight costs you $100 to ship. Terms are 5%, 10, net 30. Okay? So record this transaction using the periodic method. So what are the first things that we're going to recognize? We're making a purchase of inventory. So what accounts are we going to recognize? Or even what's the very first thing when we journalize our transaction?
Purchase of the coffee.
Yes. Now, what do we categorize those as, especially when we're using periodic inventory?
Assets.
No.
No? Oh, I'm sorry.
Yes,
Expense.
good. Purchase good. Expense. So what accounts are we going to be using for this particular scenario? Accounts payable is one of them. Good.
Purchase discount?
Purchase expense, not purchase discount. We haven't taken the discount yet. So good. Purchase expense, freight expense, and our accounts payable. So remember, freight in this kind of scenario, freight is going to be a separate cost in order to purchase my inventory. So we have purchase expense, right? We bought 100 toys for $1.25. So giving us a grand total of 125. Okay. Freight was another 100 and we placed it all on an account. So now I owe $225. Okay. Now, scenario here is scenario 1. Now, what if on February 9th, okay, so my first purchase was on February 1st, so February 9, I decided that I actually paid Cuppy's Co. a check for the purchases of the inventory, okay? And my terms are 5% 10, net 30. Now, here's the question. When I actually paid Cuppy's Co., did I actually make it within the discount period? Yes, good. So now this is where we have to understand, how are we going to journalize this discount period? So there are a few things that we need to understand. We have an account that we owe, right? And when we pay it, what happens to it? That amount that we owe is going to disappear. Okay. Second thing is we need to pay for it. So what is your assumption that's going to be?
Accounts payable,
Accounts payable. What else?
debit,
Yes, good.
and then we put the discount and credit 5%, right? 625 is for that.
Correct. And then how did we pay for it?
Check.
Yes. So all of these, that is exactly correct. Now in this case, because just as generic as possible, purchase discounts is going to be the account. So first thing first is when you owe somebody money, you have to pay back exactly how much you owe. However, because we received a discount, we need to have an equal, or we need to create that line item where it allows us to calculate how much the discount was. So again, 5% of 125 is actually going to be placed here under purchase discounts for $6.25. Whereas the remaining check that I'm going to be writing out is for going to be $218. Now, here's another question here. How come I didn't discount the entire amount of the 225? Now, so here's the concept here. What terms does is it only allows you to take a discount off the purchase price itself. Okay? Now, this 225, what else does it include? It includes the shipping cost. Now, you can never take a discount off of shipping and handling, because shipping and handling, of course, the whole purpose of shipping and handling is it's getting the items to your store. It's a complete separate cost to the item itself. And no matter where you're at, do you think if you go to UPS, do you think they're going to give you a discount for shipping an item to somewhere? No. You have to pay in full no matter what. So the concept here is you can never take a discount off of freight, tax, whatever it is that's a separate cost to the item. So terms are only given for the discount off the original purchase price and the original purchase price only. Okay? So in this case, I did it on my total amount, which was $125. I took the 5% discount, which gave me $6.25. So then, of course, if I do this, my simple math, if I know that $225 is my grand total, and I subtract the $6.25, how much remaining am I going to have? The $218.75. And on top of that, now my debits are equal to my credits. Okay? And also understanding this as well. We owed somebody, now we're trying to decrease the amount that I owe. I don't owe them anymore. So therefore, I need to debit my account. Second thing too is, am I increasing my cash flow or am I decreasing my cash flow? In this scenario, I'm decreasing my cash flow. So that is why I have it as a credit. Okay, so yes, if you guys have your little accounting model, this is where everything starts piecing together and making sense. Okay? Any questions in regards to scenario number 1? Okay. Now, what happens in scenario number 2? Okay, so pretend scenario number 1 didn't happen, right? I didn't pay for the items just yet. I still purchased the items on February 1st. So now this is fast forward scenario number 2 is now it's February 15th, okay? And I decided to pay Cuppy's for my purchase, okay? Terms again are 5%, 10, net 30. So now let's actually look at this discount. Did we make the discount period? No, we missed it. So then how do I record this payment? Even though I am within the 30 days, I still was responsible to pay for what I purchased. However, I missed the discount. I missed the discount by 5 days. So how am I going to record this payment?
That is purchase expense.
We don't need a purchase expense anymore. We're paying what we owe now.
Accounts payable debit 225.
Correct. And then how did I pay for it? Correct. So in this case, because I missed the discount period, I don't even need to recognize it. All right? So that is gross method. You only calculate the discount when you pay, but it's also going to be determined when you also paid as well. Did you make it within the discount period? If you did, then great, record the discount. But if I missed it, then great, that's okay. I still paid for it, but I don't record the discount. Okay? Any questions for the gross method? Now, let's look at the other one instead. Okay, so now we're going to look at the net method. Okay, so same scenario, except now we're not looking at the gross method, we're looking at the net method. So here on February 1st, I purchased 100 coffee mugs from Cuppy's Co. On an account. Okay, and again for $1.25 each. Freight cost me $100. Terms for 5%, 10, net 30. So now how do I record this transaction using the periodic method? Okay, so again, net method means we're going to take the discount now. So how am I going to journalize this?
Purchase
Purchase expense.
Purchase
Okay. And what else? How did I pay for it?
account
Yes, correct. However, this time, with that being said, because we're taking the discount now, we're going to automatically assume, and we're just going to take that discount, that 5% off of the original purchase price right then and there. So notice this. My purchase expense is now for $118.75. And my freight expense, of course, we can never take a discount off of it. So therefore, it is for the full $100. So therefore, I am making this assumption that I'm going to owe this person $218.75 right off the bat. Even if I get the bill and it says that I have it for the full amount, this is me taking this gesture and already taking the discount now. Okay? So then let's go ahead and do scenario number 1. February 9th comes around and you decide to pay Cuppy's Co. for your total amount for your purchases. All right. Again, terms are 5%, 10, net 30. So how am I going to record this actual transaction right here? How am I going to record this payment? Accounts payable. And how did I pay with it? Checking. Now, let's go ahead and talk about how much are you actually paying?
Take the discount.
180.
Yes. We already took the discount already. So if we are good with paying our bills, we don't need that extra journal to recognize that we have a purchase discount. We just go ahead and just pay for what we've already done, because in the previous section, we already discounted the items. So that's the difference between the net method and the gross method. Okay, so one is we understand what the terms are and we just discount it right away. No account necessary is needed. You don't need a purchase discount. And then when the day happens and you actually pay on time, then you just pay for whatever you originally wrote your amount for. Okay, that's the difference. Now, let's go ahead and apply scenario number 2. Now, what happens if you forgot and you end up paying on the 15th of February? So here, we missed the discount period by 5 days. So how are we going to calculate, or how are we going to journalize this?
Accounts
Yes, we have an accounts payable, good. What else are we also going to include?
the discount loss, the what do you call it?
Good.
The purchase discount.
Yes. And then what else? How did we pay for it? Good. Now, what are going to be my account numbers? Like, how much am I going to place for my accounts payable, and how much is my checking going to be, and how much is my loss on the discount going to be for?
Would be the 5% loss.
Yeah, it'd be the 5%, be the, was it 6?
Correct.
Six-
Now, how are we going to arrange it in a way where it will make sense to us? Where are we going to journalize our loss on the purchase discount?
the debits.
Correct. So yes, this is what's going to happen. You are going to recognize that originally that you stated that this is what you owe. But again, because we missed the discount period, we have a purchase discount loss. And then at the end of the day, we're going to end up paying a grand total of $6.25 more than what we actually owe. So here you go. Okay. Now, purchase discounts is now going to be considered a contra account.
And loss.
Yes, because remember, so let's go ahead and go back up here. If the original purchase is going to be a purchase expense and a freight expense, okay? And then what happens is a purchase discount is actually going to reflect in the opposite direction because it's going against your purchase expense. See, your purchase expense was a debit, your purchase discount is a credit. So it's going to flow in the opposite direction. Now, if we miss that discount period, then we're going to create a purchase discount loss. So this is a contra account. So because the purchase discount is originally a credit, a contra is going to flip one more time, and now this is going to be on the debit side. So Here's an example of what a contra account looks like. It's going to appear and it's going to flow in the opposite direction as either the sub account or the main account. So in this case, my main account is going to be my purchase expense, and my discount is going to, in another sense, lower my purchase expense by creating an opposite flowing credit. Okay, so this is our first time looking at a contra account. All right, so that's just something that you want to keep in mind. We will be looking at more and more other contra accounts as well as adjustment entries. So I'll talk about the difference between them later. But that is it for that. So understanding the difference between the net method and the gross method. Okay, again, gross method is generally used more often because, again, businesses, a lot of things happen. Maybe you need to pay the rent bill. That's more important than paying off the items that you owe. So, and on top of that, it's just an incentive just to pay a company back. So in this case, if you can afford it, then go ahead and pay for it. But if you can't, then that's fine. Where the net method is generally used for those who are really good at paying their bills. Like, if I receive my bill and it's due on the 25th, I always pay it on the first week, or on the very first week. So if I do that, then yes, I will get the discount no matter what it is. So that's what the net method is. And oftentimes you want to be careful with net methods just because if you do forget to pay on time, then you're subject to create a purchase discount loss. Okay? So again, course chapter review. So again, we talked about periodic inventory. We talked about the two different tracking methods, which are periodic and perpetual. We talked about how shipping works, okay? And we also talked about an example of how to journalize a purchase of inventory if it's a periodic inventory. So again, you're going to recognize purchase expense and freight expense, and if it's on an account, there you go, okay? Other things that we also looked about is going to be looking at purchase discounts, which we looked at two methods, the net method and the gross method. So here's a perfect example of making the purchase in the first place. One of them is recognizing the discount immediately and then paying for it. But if you missed it, then you have to record the discount loss. The other side, the gross method, recognizes that you made the purchase of inventory. And when you pay for it and you made within the discount period, you take the discount, the purchase discount. And then if you don't and you miss it, then that's fine. You just pay for what you originally set out to owe for. Okay? Any questions in regards to... Sorry, that was any questions in regards to chapter 5.1? No? Okay, let's go ahead and get started with the 5.1 exercises. So let's go. And here we are. So first things first is we're going to practice journalizing again. So in this case, I only taught you a few journals. We haven't, in this kind of case, the general assumption is you have a purchase expense and a freight expense. And if it's paid with cash, then go ahead and make that assumption. So in this case, I'm going to assume everything is going to be paid with cash. Okay? So number one. All right, so let's record this. On April 5th, you purchase 1,000 units at $5 each with a freight cost of $100. So how are we going to journalize this? Yes. Don't forget the date first. So purchase expense.
Yes.
And then we have freight expense. Okay? And I said that we assume that we're paying with cash. So what's my credit account going to be? Good, cash. So what is my debit going to be and what is my total credit going to be? So what was my original purchase expense?
1,000.
$5,000, yes. So this is where we also talked about how one of the rules is that you need to journalize in terms of dollar value. So you cannot write 1,000 units. You need to write the total amount that it cost you in terms of dollars. And again, freight is 100. So what's my total amount of cash I'm paying?
5,100.
Good. And then here, of course, you can have a description. We'll practice descriptions in chapter, actually when we go dive into actually journalizing. But I'll go ahead and practice it for now. So in this case, my detail is that I purchased 1,000 units at $5 each. Okay. All right. So the next one is on April 10th, you purchased 750 units at $5.75. Freight cost you $75. So how do I journalize this? Purchase expense. What else? Freight expense. Good.
Expense.
In cash.
And cash. Good. Now, what are my amounts going to be?
7 times. Don't have calculator here.
Okay.
4,312.5 for the purchase.
Okay, hold on.
expense.
It was 4,325.
4,312.50.
Okay, and how much was my freight expense? 75, giving me a grand total of
5,062.
try again.
No, 4,387.
Good. All right. Same thing here. Description's going to be you purchased 750 units at $5.75 each. Okay, so that's what your description is. So then you can recognize what's going to happen. Now the last two scenarios, so April 20th, you purchased 200 units at $6 each. Freight's going to cost you $20. So how are you going to journalize this?
Purchase expense.
Expense.
Yep,
Forget the date.
420. So that purchase expense. What else?
Yes.
Freight expense.
Good. And then cash. Okay. Now, my scenario here is that I purchased 200 units at $6 each. So 1,200, and freight was $20, bringing my grand total to be $12.20. And again, I'm going to also indicate here that I purchased 200 units at $6 each. Okay. I'm going to add probably 2 more. Okay. Now, last but not least, we have on April 25th, you purchased 500 units at $6.25 each, and my freight was $50. So how am I going to journalize this?
The date,
Was it the
purchase
25th? Did I
expense.
say the 25th? Yes, I did.
25th,
Okay.
yes.
And how am I going to journalize my transaction here?
Purchase expense,
Mm-hmm.
freight,
Mm-hmm.
cash, and purchase expense is
31.25. How much is my freight? I'll go up. There you go. $50. Good. Bringing my grand total to be 3175. Okay. And again, I'm going to enter in my description here as purchased $6.25 each. Okay, good. So that's just practicing how to just journalize. Always remember purchase expense comes first, and then however you paid it is going to be your credit. Okay, just remember. And also another thing too is any costs that are going to be associated with your purchase expense is going to be considered a separate account itself. Okay. Number 2 says what costs are included when making a purchase for inventory. Sales tax, shipping, good. Sales tax, shipping. Storage fees, yes, good. Okay. Number 3 says what are the 2 tracking methods of inventory?
Periodic.
So I'm going to push that over. So yes, A, periodic, and perpetual is the other one. So periodic and okay. Then number 4 says, what does the net method mean?
And you're taking the discount
Yes,
immediately.
take discount immediately. Okay. All right. And then now we're going to go ahead and practice the gross method here. So using the gross method, okay, periodic inventory, if you made a purchase on April 5th of 1,000 toys at $5 each, okay, with freight costing $100 on account. The vendor gives you terms of 5%, 15 net 30. So journalize this transaction. So what was the date?
Purchase expense date April 5.
Say that again. April 5th. Okay.
April 5. Purchase
Good.
expense. And then freight cost.
Okay. And then how did I pay for it? Yes. Now, how am I going to journalize this though? 5,000. Good.
And then 100 freight expense.
And my total is going to be
5,000.
okay.
5,100.
If you want to, again, I'm only just having you guys just practice understanding this concept, so I'm not going to put a description there. Okay. Now, number 6 says that continue with question number 5. You paid the vendor on April 15th. Journalize this transaction. So it's April 15th. What happened on April 15th? We paid the vendor. Accounts payable.
Debit
Good.
account payable.
$5,100.
Good. 5,100. Debit. Oop. There we go. Scroll up. And then what happened here?
So purchase discount.
Yes,
10%
we
discount.
made the discount period because we paid within 10 we paid within the 15 days. We paid 10 days later. So we definitely made the discount period. So what is my account going to be?
250.
Purchase discount, good. Discounts, however you want it. And then what is my other credit going to be? How did I pay? I mean generally where would it come out of? Yes, it could be your cash or your checking account. Whatever it is that you do means of paying this vendor. Now let's look at this carefully. How much is my discount for? What percentage am I going to be calculating? 5%. Now, which amount am I going to be discounting off of? Yes. Okay, so how much is my actual purchase expense going to, what's the discount going to be for? Say that again?
250.
250? Yes, good.
Yes.
250. So how much am I going to actually pay?
4,850.
Yes, 408.50 cash and checking. Yes. So you take your 5,000, you multiply that by your 5% to give you a total 250. Subtract that from your 100, and you get $4,850. Good. Okay. Now again, number 7 says, using the information on question 5, journalize the purchase using the net method. So we're going to go look at 5 again, and this time we're actually going to use the net method. So what am I going to be journalizing here instead? So scenario, same thing. I purchase 1,000 items or 1,000 toys at $5 each with a freight cost of 100. And my terms are 5%, 15, net 30. So how do I journalize it if I'm going to be using the net method?
Accounts payable 5,100.
Okay, so we're not paying them. So here, we're just recording the transaction using the net method. So we're not paying, we're just recording.
So we put in the date and then purchase expense.
Yes. So it's going to be April 5th, and we are doing a purchase expense. What else? We have our freight expense. And then, good.
Accounts payable.
Now, because we're using the net method, what is actually going to be recorded?
So we calculate the discount up front, it'd be
It'd be $47.50. How much was my freight? Bringing my grand total to be $48.50. Good. All right, and that's using the net method. Last but not least, question number 9 says, what does terms mean if it's 2%, 10, net 30? Or sorry, net 20.
If you pay within 10 days, you can take 2% of discount. If not, you must pay in full within 20 days.
2% discount. If not, pay in full in 20 days. Good. Good. All right. Good job, everybody. So I'll post the answers right after this. So right now it's exactly 9:45. Go ahead and take a 20-minute break. So please be back no later than 10:05. Okay? And I shall see you back, and we'll go ahead and continue on with 5.2.